Hey, this is Neil Bawa, the mad scientist of multifamily, and you're listening to the Mailbox Money Show with Bronson Hill.
Welcome to the Mailbox Money Show. I'm super excited to have Lane Kawaoka here. If you don't know him, he runs the Wealth Elevator, which is awesome. He's got a book on the same topic and just always a guy I've respected quite a bit. He's a former engineer and really has done a lot, both single family in real estate, then launched to do more syndication. He's also doing a lot of private equity development, different types of things. Very high level guy. I love talking and having conversations like this. I think you're really going to enjoy this interview. We get into why he loves development specifically and what it is about development that he's really enjoyed, and also a lot of the private equity side. We're seeing there's so much interest these days in buying businesses, and we're buying a business right now. We're super excited about it because of the cash flow. That's the biggest thing that we thought in real estate that we had that's just not consistent now is cash flow. And cash flow, in my book, I talk about this. This is how people retire. This is how you quit your job. This is how you actually have money coming in without you having to work. A lot of money someday is okay, but it doesn't really help you if you have to wait years and years for it. So let's jump in this interview with Lane Kawaoka. Lane, welcome to the Mailbox Money Show. How's it going?
Hey, aloha everybody. Thanks for having me, Bronson.
Hey, Lane, I don't know if you know this. I know we were just chatting a minute ago here, but I've been following your stuff for years. You had the little jingle on your podcast about the real investor man and all the things. I've just you've been in this space for quite a while. So you're someone I've looked up to, just the things that you've done. And now you have the wealth elevator. You've got a lot of things that you're doing, and we were just kind of talking about what would be the best thing to talk about because you're also in the private equity space and doing a lot of different things. But before we jump into that, can you give people a little bit of your background, kind of how you got started and how you got to where you're at today?
Yeah, I previous life I used to be an engineer and in the construction side, so a lot of civil engineering background, construction management, but like a lot of people didn't really enjoy the job and I kind of got led on this invest in the 401k stuff and buy a house to live in. I bought a house in Seattle in 2009, and because I was a young bachelor back then, I could just do whatever I want. So I decided to rent it out, and that was kind of where things got started. Started to buy a few units in Seattle, but then realized, people don't buy properties in primary markets where the rent to value ratios are in the toilet. And I started to buy properties in Birmingham, Atlanta, Indianapolis. Went through the adolescence of investing where you buy these crappy turnkey rentals that you think is going to get you to financial freedom, but really it just was a stepping stone. 2015, I had 11 of those little rental properties, and that was kind of when I, went to the syndications and private placements and started to invest in apartments from there.
Yeah, I think it's interesting. That was similar in some ways to my path. I had in Cleveland. I went to Cleveland, ended up with four single family houses, and realized it was a ton of work. The numbers looked great, but they didn't actually always work out the way that I thought because of upkeep and all the different costs that are there. And then I realized I just couldn't scale. It would take me so many homes to get to where I could have financial freedom. And so I know you have syndicated. You've syndicated a lot of stuff now, over 10,000 rental units. And congrats on that. It's incredible. And I know you've shifted a little bit to go away from, we're talking about the kind of the value add multifamily or the distressed multifamily, and you've gone some other routes. Can you talk a little about what you've kind of done and what's made you kind of transition from that?
Yeah, I mean, when we first got started, I think we started syndicating back in 2017, 18, and we would buy just like a lot of new sponsors, a lot of crappy Class C units, 50, 60 units, just enough to have a leasing agent, maybe a handyman there. But man, things just break all the time, and you have just crappy tenants that never pay. I think on one of our best properties, we had like a collections of like 80%. So
Oh
like
my
eight
gosh.
out of 10 people pay. Um, you can make a lot of good money with that stuff because you buy these properties at good prices, but you really need a good market to kind of to help you, which we haven't had these last couple of years.
Yeah.
So we started to do bigger Class B assets, but still you run into people who are like one paycheck away from, just being screwing up your property,
Yeah.
basically.
Yeah, it
And
is real quick. It is amazing how many people like to be if you bought real estate between, especially multifamily between 2010 and 2021, 22, you were a genius just because you like it was continually growing. No matter what you did, the market kind of generally helped things out. And of course, we have had a different environment the last couple of years that without really incredible operations and solid debt, a lot of people face some pretty significant challenges.
Yeah, yeah. I mean, I'm a passive investor and supposedly some real estate investing gods, and we're losing what $250,000 every single month, right? If you
Oh
if you
man.
can't combo the debt with the right deal and good operations, I mean, that's what's going to happen. Part of it is just buying at the peak of the market, but
Yeah.
in 2020 we started to see the prices go up and started to realize that at the time, and we forget this, like class B assets were kind of class B and C assets were kind of, you could pick them up for kind of the same price, and it was kind of heading in that direction. I think it's kind of gone the opposite way today, but we were like, well, why don't we just build this stuff from scratch, because there's a lot less competition, right? Because at that
Right.
era, pre 2021, you saw a lot of people get involved, right? They think that they've been investing in real estate for 4 years, and now they think they can go buy a 200 unit, 300 unit apartment complex. So we started to develop, which I think is a big, there's a barrier to entry in there, because to get the loans to do construction, you can't just go get one rich dude and one guy who's done a 50 unit and get a loan for a 300 unit apartment complex. It doesn't work like that
Right.
in that space. You actually have to have experience in the actual construction operation side. And then also, we started to see, the land was a very big barrier to entry, right? To get 20 acres, 30 acres in a path of progress. And a path of progress is not some random piece of land that you go to the land geek and you buy some random piece of land out in the middle of nowhere. It needs to be kind of on that, where they're building the next off ramp on the major freeway, or an infill, which is a lot harder. You can barely find anything higher than 12 acres in that realm. So we started to develop and just kind of realize that we could build things for what you could buy class B assets, but for 30, 40, 50 years newer. And
Hmm.
it just kind of made a lot of sense. So we kind of started to diversify the holdings outside of what we started with. But just like how you and I started with little single family homes, right? I think it's all a stair stepping
Right.
activity at the end of the day.
Right. It's kind of like that, like I say, the Monopoly game, right? Where first you start with, getting properties, then you get the houses, then you get the hotels, and then so it's kind of that scaling up. Um, and so, yeah, with development, we've only done one development project. We've done a senior housing development in Alabama, and it's, obviously there's, it just takes a little while. Obviously, the returns you hope will be a little higher than kind of doing something standard. Obviously, you got to make sure you're well capitalized. But what would you say are some of the risks and the differences between, for an investor, especially investing in development versus buying an existing project?
Well, you don't have the good things is you don't have like the risks of like taxes, insurance, right? Because ideally you're just gonna sell that thing and you don't really have to worry about operations and stuff like that, right? Leasing it up and the tenant issues, because you have cleaner tenants too. But what you have more exposure to is like we had like the lumber skyrocket 4x on us during construction. So we
Yeah.
we were at again, you forget all these things, and this was only in 2020, but we pre-bought a lot of the lumber before things really got high. But still, it's more expensive. You assume you're going to recoup it on the back end, right? Because everybody
Yeah.
has to deal with the same issues. But those are a lot of the things that you just can't. You have to absorb those risks. We'll try and do like maximum price contracts with the contractor so it doesn't exceed a certain amount. But you can't really do that with materials unless you want to
Yeah.
pay a stupid price for that. A contractor would love to do that for you. But it's just like buying two cranes if you're building a bridge, right? Having one on standby. Like
Right.
they'll price it in, but like you're just not going to want to do that.
Right. Yeah, it is interesting, with I mean, we all know kind of long term, 5, 10, 15 years in general, everything is going to cost more. I mean, that's one thing we've seen over the years, especially the COVID, just the creation of new currency, the cost of everything going up, the fiscal irresponsibility. I guess the challenge, one of the risks, obviously, as well, is that when you're ready to sell or when you're ready to be done with the project, you are kind of subject to whatever the market has available, right? Whatever the pricing is, I guess you could hold for a year or two, especially if it's a great asset. You could say we're going to lease it up, we're going to do this as whatever, and then sell it. But or just hold it longer and cash flow it, which I guess gives you a lot of the margin of safety, as Warren Buffett say, right? It's just having multiple exit strategies. But how many development projects have you guys done, or like where are you at with the ones that you've done? Have you sold any yet at this point? I'd love to know kind of a little more about that.
Yeah, we've got a couple that are complete, but both of them came at a time where the market was down. So we had to enact that second multiple exit strategy that you mentioned, which is, and this is up to debate, right? Like, but if in my head, like you want to sell the asset when you've increased the value the most, just like a multifamily like class
Right.
value add. Once you've renovated the units, you ideally want to just sell that sucker because it's only going to go down after that. Ideally, just like with the construction, once it's built up and leased up, you want to sell that thing. Whether that's 90% occupied is normally the fattest you're going to get that hog, and you're going to slaughter that hog at that point. But with, kind of timing worked out, I think that when we got to that point was like November of 2022. So interest rates had skyrocketed, and certainly the cap rates started to increase at that point, meaning that the prices kind of fell. So we just kind of refinanced it and stayed in a note. I think we did 5-year note on that one, and we'll just hold on that one for 5 years. But that's it was kind of a bummer, but hey, at least what are you gonna do in that
Yeah.
situation, right? But that's why, like, ideally you sell, right? You take your chips off the table and you go
Right.
re-leverage it into multiple projects. We've got like 3 that are kind of waiting to go at this point. But right now, if you were to go into a construction loan, you're going to be looking at like 10% plus
Yeah.
going into those notes, maybe even
Are you,
12, 13%.
are you guys doing more construction projects now, or have you guys put that on hold since rates have risen, or what's kind of your current strategy now?
Yeah, it's kind of a holding pattern, right? The nice thing is that you haven't really entered, you buy the land cash, but you're not really, it's like you're not really, your timer's not going, right? When you're in like a regular project, you enter your commercial loan, you have some type of timer going, whether it's a bridge note, 3 years or less, or even 5, 10 years, that timer is going. But when you own it cash, that timer's not going. Obviously, you're not using leverage at that point, which is another thing, but it's kind of a benign project at that point. So you can we have the luxury to just sit around and wait.
Yeah, yeah, that's great. They say, don't wait to buy real estate and wait. And so that's obviously a huge thing. But it kind of goes back to the fact too that real estate for a lot of folks has been more of a long-term strategy. And for people like myself, or I know like for you that left jobs, to go do real estate or to invest full time, a lot of my cash flow that was pretty present got eaten up by debt costs or other things, costs of material, different things that happen, and the cash flow really is the thing that has been missing. Can you talk to us a little bit about kind of what are some other things that you're doing to help yourself and investors to get more cash flow these days?
Yeah, this is a lesson learned for myself. I mean, I was very gung-ho in my 20s and early 30s on real estate, right? Like I had 100% of my assets, especially when I had 11 rental properties and getting into syndications in real estate. But it's also what got me here. So I'm not going to discount that
Right.
for sure. You know, but in the last commercial real estate correction that we've seen here, that wasn't a good plan, right? So I got hurt pretty hard. But part of that is like, unless you have a substantial net worth, I think at least 2 or 3 million, it kind of, you get into this debate on like, is diversification, for idiots, like how, I don't know who said that, Peter Drucker, one of those guys probably said that.
I think Warren
Or
Buffett said something like that. Yeah, yeah,
yeah, watch your nest of eggs and like a hawk or whatever they said,
yeah.
right? Versus diversification is for idiots because you're not an operator, you can't really do
Yeah,
anything, so you need to diversify, sir. We all have buddies like that, right? We should just do
yeah,
the S&P 500.
right.
But I mean, just speaking for myself, right? And part of this is like kind of knowing other investors in the space. What I started to see what I do is I look what other high net worth people are doing and trying to emulate that. And what I saw is maybe they did their own business, so they were highly concentrated real estate like how I was, but you start to diversify once you get to a certain point. And kind of what I say is like end game for most people is about three, $4, $5 million net worth. Why? Because you can put that at that 4% roll and have a pretty nice existence at that point. Of course, most of us want to kind of keep pushing that, especially if you're younger, below the age of 45, 50. But at that point, it's a good threshold where you do have the luxury to put your money into life insurance, right? And make a nice return, almost risk-free. Um, but you can also, there's other asset classes out there, right? Like venture capital. Um, Venture capital is more on the spectrum of, this is like, shooting moonshots, right? High risk, high return, typically no existing P&L, which is why I like the apartments and why I like, private equity, where you're investing in a
Yeah.
business with an existing P&L, right? Whereas, this might work, it might go to the moon, it might not, right? I mean, I'm kind of dabbling in that world a little bit. Part of it is I'm just blindly following people that I respect what they do, right? They'll take a small amount of their net worth, 1 to 5%, or back and forth on these percentages, of course, a lot, and they'll go asymmetric with it. But the majority of their net worth is in stable assets and maybe life insurance or even stocks, right? Which I, for one, was not a big fan of for a long, long time. Still don't have very, very much, probably less than single digits. But I do see it's a place in people's long-term portfolios, especially when they hit a certain amount.
Yeah, absolutely. No, it's interesting. Tiger 21, they basically the average member is over 20 million plus, and they do this allocation. You've probably seen this every quarter. They do the allocation amount of where they're invested, and I think the highest amount that they're invested in is private equity, and the next is it's like 25, 26%, and the next highest is similar to that is different commercial real estate and other things. Very little in public equities, but a lot of other private types of things. And the quote Warren Buffett says is he says, wide diversification is great for people who don't know what they're doing, right? So it's kind of the idea of just wide.
Yeah.
So for
Or
some
don't
people,
know
though,
anybody too,
yeah, I
right?
don't know anybody.
That's
Yeah. And I was for a few years, I was a registered investment advisor, an RIA. I still call myself an RIA. I'm a recovering investment advisor, but it would basically just talk about, you'd see people that have wealth and it'd be trying to kind of maintain and not lose the wealth they have due to inflation or bad investments, right? But if you're on the way up, like you said, you're trying to actually grow wealth, sometimes taking on a little more risk in certain ways or a little bit higher growth strategies can be very valuable. And we love the private equity strategy as well. And we've basically we've done a little bit of that with car washes. We've done just for a cash flow perspective, oil and gas, other things like that. But we're, like I mentioned before, buying a $27 million e-commerce business. And the biggest thing is because of cash flow. And that's the thing I think for a lot of investors, when you buy a stable business, you have operating history there, right? And a lot of businesses fail within the first 5 years, but if you buy a 5-year-old business or more, you have a lot of history there, and it's much less likely to go to zero or at least have major issues. I mean, there are other issues, of course, with businesses. What have you learned, I guess, in the private equity space? Is this actually, I was going to ask you, is this something you brought investors to as well, or is it something you've just done personally, or kind of what's your role in the private equity space, and what have you guys done so far?
Yeah, so our role is like we'll partner with the operator, right? I mean, and no different than when we were operating the real estate. But when you start to get outside of your world, like as we are, I'm not I'm not a plumber, I'm not a pool cleaning company, I'm not a digital marketing agency or CPA franchise. That's not my world. But we come in as a fund manager role with the money side, and we partner with the operator, and we do our checks and balances. And we do diligence on the ideal. I mean, I'm sure you're kind of doing this too, right? You're looking for synergies where the only thing that's stopping you from taking the next step to buying a competitor, taking up an extra market share, is money, right? And
Right.
sometimes money solves problems, so we've heard the same too. um, and that's kind of where the money can take you to the next level. And there's a nice JV structure that needs to be negotiated. Every deal is different, where investors bringing in $1 million, $2 million can be key to unlocking that next level and profitability for everybody.
Yeah, that's great. No, I think it really is true. There is an economy of scale that, once you're and you see it in businesses, you see it in real estate, what you can bring a certain amount of money to a deal, it really you're able to get a lot more done. And I think to the conversation earlier about development, not everybody can go buy a business that's for sale for $10 million, right? But with SBA loans and other things, there are ways people can put that together, put together some sort of loan structure and have it make sense, which I think is really good. What do you see as some of the risks of kind of the private business side for a passive investor? Maybe somebody hears about a deal that we're doing, you're doing, somebody else is doing, and what are some of the kind of the diligence process you'd go through as a passive investor to kind of understand that and kind of eyes wide open going into something like that?
Yeah, I think like the reason why a lot of us like real estate is there's supposedly something tangible there, right? You can feel it, touch it, and the whole argument of like, people need a place to live and do business, right? We got it. But I think that, when I first started to get outside the world of real estate, that's what I kind of clung to at the end of the day. I think part of the due diligence is like, you look at this like a business. And even if you look at the multifamily stuff as a business, there's a P&L there, right? There's existing revenue coming in. And usually the sponsors will do the due diligence on, where's the rent checks coming in? Are they getting, we have a rent roll, but verifying that is the money coming in from the rent roll into the bank accounts, right? Is that because you hear horror stories
Yeah.
of, fictitious financials like that, but no different with, sure, there's no physical asset here with the business, but in a way, like the client list is maybe worth more than a
Yeah.
physical asset. But certainly you have in this world, what we play in kind of the digital marketing space, digital business space, you see the recurring revenue coming in, right? And sometimes it's actually a lot more verifiable than having some rent checks fall into an archaic bank account, right? You got like these third party processors like the PayPal. I think people understand PayPal, Stripe, right? You can verify these types of things. You can verify site traffic through these parties. So it actually makes due diligence a lot easier. And then secondly, like what we found is like the ecosystem is a lot smaller, right? I think you and I both know kind of the commercial real estate ecosystem of a lot of operators in this world. I would say that in the digital business space, it's maybe about a tenth. So you have this effect where people know each other and people don't want to shit the bed in a place where everybody knows each other. It's kind of
Yeah.
like the Hawaii effect, right? Nobody acts like an asshole because you have to live with them because they live on a freaking island as you. Um, but that it kind of makes, when you're transacting a lot more cleaner in a way. Kind of adds that layer, another extra layer to the due diligence there too. But I mean, at the end of the day, I think it comes down to like, and again, not gonna knock real estate, right? We still do it. But when times get really, really tough, like we've seen the last couple of years, there's not many levers that you can pull,
Yeah.
right? I mean, if your insurance triples and your taxes double, that is under the category of uncontrollable expenses. And when that, that like, I mean, there was an article the other day where in normal people's budgets or their mortgage, PITI, the taxes and insurance is making up half of their entire mortgage payment
Yeah. I
these
saw that.
days. Yeah, it's crazy.
Crazy.
And if you're just looking at a P&L for an apartment owner, like that's a huge, huge amount of uncontrollable expenses. And unlike businesses, there's not really much you can do to increase the revenue. It kind of is what it is, which in the past history is great because it's, an idiot can kind of run this one stick ship in a way. But with businesses, there are so many things that you can change and tweak to increase revenue to get yourself out of the quicksand if you need to. It is technically a lot more volatile, but I like the ability to kind of get yourself unstuck and moving forward. And to kind of take a personal development spin at this, like I mean, sure you've heard the saying, if you're not moving forward, you're moving backwards.
Yeah.
No different than businesses, right? If you're not improving that sucker, kicking ass, and trying to sell that thing pretty quickly, once you capitalize that gain, once you fatten the hog, then you might lose your window. And I think that's the knock on real estate is there's not
Yeah.
many things that you can do in that world.
Well, and sometimes too, there's things that I've seen where we've had deals. We bought a deal years ago in Jacksonville, and it went up. Just the value of the property just by owning it. I mean, timing, it went up something like, I mean, it was a crazy return. It was like we sold it 1 year later for almost double the money that we put into it, right? It wasn't anything we did, but we, everybody looked like a genius because we had this great return. But it's like you said, a lot of it's out of your control. So when the market's going up, you're positioned well. But then, like you said, all these uncontrollables. And these days, there's been so many of those things that have popped up, right? Like, well, higher rates and also higher insurance, higher costs, higher inflation. Rents have been stable or maybe coming down or maybe slightly. It's been a much smaller side on the rent growth side, and so. There are a lot less things you control. And I think with private businesses, kind of as you mentioned, the risks are different. There are more risks in some ways, but there's also more control. There's ways you can come in, and like the business that we're buying, this niche cosmetics and women's apparel business, it's like, we see all these things that the owners or the current operators are not doing. They were like, well, they're not doing this. They're not using influencer marketing. They're not doing that. There's like a series of things that they're not doing. And even though we're not buying this big tangible stack of whatever, because it's a drop ship company from overseas, it's like the revenue's there, the business is there, and the cash is there. And I think that's really awesome. Um, I wanted to just ask you one or two more questions before we wrap here, but tell me a little bit more about kind of what you're seeing, I guess, going forward here, 2025. What are some kind of things investors should pay attention to? Do you have any predictions as far as rates or what are great assets? I mean, obviously, it sounds like we're kind of positioned a lot of the same ways of doing things that are a little either longer term or cash flow related. Is there anything else that you're paying attention to when it comes to 2025 in your investing?
I mean, obviously, none of this is financial advice or
Right.
whatnot, but in one of our assets, we saw the value go up by 10% through an appraisal earlier in 2024 and late 2024. So that's just one data point. But this is maybe a sign that the bottom of the market was a few months ago,
Hmm.
potentially. Um, I don't know where interest rates are going. All I can do is point to the Chantilly financial curve or the CME, and everybody should have that bookmark on their desktops out there. But that, if you're thinking that interest rates will come down slightly, maybe settle into the 3.5%, 4% range, just kind of long-term projections. Who knows what's going to happen, right? We don't know if we're going to go into war or another pandemic, but that's kind of the general consensus out there. I will say that there is a a tale of two tapes out there, right? Like deals that were purchased in 21 and 22, they have high bases.
Right.
They just were bought for too high of a price. So there's going to be one side of the story that says those notes are coming due, and they are, and they're going to be so distressed. But I would say separate it from deals that are purchased today because they're purchased with completely different bases. And that's kind of it's just a huge different thing that I think most investors they don't differentiate between the two, and they're going to miss out on this bottom, which I think might have already happened at this point.
Yeah.
Basically, it's kind of like you fed garbage to your cows 2 years ago, and we don't know how the meat's going to come out. We know how the meat's going to come out, right? But now we got good feed to give the Wagyu cattle, good food right now. We know how that's going to end up 3 years
Yeah.
from now. So I think a lot of it has to do with the basis. And some people are in some old 21, 22 vintage deals. We know how that's going to end up. It's not going to end up well. You're going to have to, even if you're able to get it over the hump, you're going to wait for 3, 4, 5, 6 years to get back up to that higher basis. Where right now, I mean, you almost can't miss with the evaluations bought at 20 to 30% lower bases today.
Yeah.
So, I mean, just wanted to highlight that because I think a lot of people just get that confused, right? People are like, well, I see this debt wall coming down. Like, yeah, I think that's my narrative here, that debt wall will happen. We know it's going to happen. It's just math. All these notes are renewing, but that's going to mainly impact those particular assets bought at those higher peaks.
Yep.
And part of that is like, my whole lesson learned is, when you are in bridge notes that are expiring in less than 3 years, you can make a lot of great money, but you have that exposure that there can be a huge correction that lasts as long as we've seen here. You could go in with long-term debt, but then you don't have the same expectations for returns. But right now in 2025, 2026, 20, maybe even 27, you can go in with whatever, long-term debt that's more costly, and you can make a killing because the basis is low right now.
Yeah. Yeah, that's a really great point there, Lane. I think that we took a 2-year break as well from multifamily, and just because the numbers weren't making sense, and now we're seeing stuff, in great booming markets, discounted 15 to 30% from where they were, 2, 3 years ago. And so I think that it's that whole be greedy when others are fearful, right? And we're seeing some fear in the market. Instead of 30 offers at the table, you might be the only one. The current seller is going to be losing $4 million on the project. Like, there's some things out there that right now it is a great time. So I'm not a big one of timing the market, but I do think paying attention to valuations and relative valuations or historical valuations across different assets is very important. Lane, I really enjoyed talking with you, man. It's great. I know we haven't really talked a whole lot, and I've seen you at a few events, but we got to definitely talk some more. Love what you're doing. I know you've got the Wealth Elevator, you've got your book, you've got your podcast, you've got all kinds of things you're doing. Can you tell our audience how they can follow you and get in touch and hear about your deals?
They can check out my book, The Wealth Elevator, on Amazon. Um, I think we got over 100 reviews on there, I think. Or you can shoot me an email, lane@thewealthelevator.com.
Awesome. Lane, thanks for being here, brother. Appreciate you, and look forward to connecting again soon. All right, love that interview with Lane. A couple takeaways for me were really to focus on the things that are actually working for you. Really, where is your edge, right? That's something we talk about. If you're good at one thing, there is a natural progression, right? You start with single family, which I think you sometimes don't always have to do. Then you go to multifamily, then you go to development. You don't have to go in that order, but as an operator, it can make sense because it allows you to kind of scale on prior learnings. We've also done that with now moving into private equity, moving into oil and gas, moving into other types of investments. In my book, Fire Yourself, I talk about this, about how you can, once you start with one thing, multifamily is a great place to start with, or some other types of real estate deals, it allows you to expand to the world of other passive investments. And that's what you can say is, hey, really, what are my goals? What's the problem that I'm trying to solve? And if it's for cash flow, or it's a tax issue, or just long-term appreciation, maybe in a retirement account, you can find investments that will help you solve for that. So anyway, really excited about this. We talk about topics quite a bit like this on this show. We also, you'll see it here, this is called the Wealth Forum. It's our newer mastermind for high net worth passive investors, which we have, that meets in person once a quarter, and we do virtual calls. It's been awesome. If you're interested, you can reach out to our team on that. And if you haven't joined our investment club, you're not hearing about our awesome deals, including the upcoming ones on cash flow with private equity private equity business deals, which we're really excited about, which we have one that we're working on right now. So thanks for taking the time to educate yourself. Look forward to seeing you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.